Hello guys, this is Renkat on Renkastar FX. Today I will be talking about risks and money management in the Forex industry. Risks and money management is one of the greatest things traders should take note of because it is probably the major cause of traders' failure. Now, professional traders focus on how to minimize risks while maximizing the profit, but the amateur focus on how much profit to make when placing a trade. Know that no matter how good your trading system is, there is always a room for mistake. No matter how skilled and compelling your analysis is, it will often be wrong. Worse analysis can lead to losing streak and damage your account balance, and as well as offset your emotions. So adopting good risk management can reduce the odds of losing and increase winning. The ability to survive long enough in this industry and to succeed is less matter of how much you make when you are right than how little you lose when you are wrong. Bad risk management can create stress that leads to bad trading, and it can also cripple traders' equity as well as their mind, making them believe that no one can make it in the Forex industry. Risks and money management is very broad in the Forex industry, but I will try as much as possible to streamline it to the basic aspect of the risks and money management. But first, the big question is there risks in the Forex industry? Is Forex a risk-free? Now, if you are in this industry already, you will hear traders and investors talking about some techniques, some terminologies like risk appetite, which means a buy for risk assets, and risk aversion, which means sell for the risk asset. Now, this implies that whether you buy or sell a risk asset, there is always risks involved. So you can't avoid risks in the Forex industry because Forex market is not a risk-free market. Likewise, other markets, life itself is a risk, but you can minimize the risks and maximize the profit in the Forex market. So in this video, we are going to assess the risks, analyze, and possibly look into the ways to mitigate the risks and reduce it down to the lower level that is safe for profitable trading. Now, in the risk assessment, we are going to first of all identify the risks across the Forex market. And there are 6 major risk factors in the Forex industry. Number 1 is leverage risks. High leverage product has high risks. Due to the limited capital from traders and investors, liquidity providers provide leverage to retail traders and investors to enable conducting substantial foreign currency trades. An initial investment will be required of you, which serves as a margin. Under high volatility or adverse conditions in the market and the margin level is low, a margin call will be activated. The investors and traders will have to pay additional money to increase their margin level and to keep the opening positions running, or else the broker closes the trade positions automatically, and this results in a big substantial loss. So high leverage or low margin level leads to high risks. Number 2 is transaction risks. The risk related to time difference between contract commencement and a settlement is known as the transaction risk. This is one of the main risk factors in the Forex trading and is contingent on exchange rate changes. Since Forex trading is active round the clock, exchange rates are subjected to change before trade settles. So you can trade currencies at different rates at different times of the day. The longer the duration between entering and settling a trade, the greater the risk. So with fluctuation in exchange risks, traders may face excessive transaction costs. Number 3 is interest risks. When a particular country interest rate goes up, internal investors may look to increase their investment in the country, boosting or increasing the demand and thus the price of that currency, and declining the interest rate may also bring down that country's currencies due to the withdrawal of investment. So this may result to an unexpected move of price and most likely leads to considerable losses. And number 4, country and liquidity risks. In the multiple developing nations, the currency exchange rate depends on a leading currency, such as the USD. In order to ensure that exchange rate is maintained, the developing countries must have sufficient reserves. Now, if there are frequent deficits in payment, the developing country may face a significant currency devaluations. This in turn affects the prices in the forex market. It can prompt investors to withdraw to avoid losses in the anticipation of the currency crisis. And this, together with government restrictions and policies, lead to low liquidity in the market. And brokers increase spreads in the low liquidity market. When there is low liquidity, there will be high volatility, and this results to losses for traders on low margin. Now, number 5 of the risk factors is counterparty risks. In the financial transaction, the company that deals the assets to the interested investor is known as the counterparty or a broker. Sometimes brokers may fail to execute a certain transaction due to the high volatility in the market. This mostly happens during big news in the market. As a result, the trader may suffer losses. For instance, you want to close a trade to reduce losses during a high volatility, but broker refuses to execute trades until it hits your stop loss or wipe your account balance when there was no stop loss at all. Number 6, which is the last risk factor, the credit risks. Credit risks refer to the possibility that an outstanding currency position may not be repaid as agreed due to the voluntary or involuntary action by a counterparty. Credit risk concerns only corporations and banks. For individual traders trading on margin, credit risk is low because you're only trading on margin, the little money you put into the trading account. Also, because of the fact that National Future Association (NFA) and Commodity Future Trading Commission (CFTC) regulates the registered brokers or counterparty. Putting your money with the counterparty or brokers that are unregulated by these authorities lead to high risks. So since forex trading involves a degree of speculation and a multitude of international factors, risk is inevitable. Time difference, volatility of leverage trades, and the political issues are few examples of catalysts for the big losses. Moreover, the resultant impact on different countries, financial markets, and currencies can also be significant. However, when done right, under a minimized risk environment or condition, forex can bring great returns. Risks and money management strategies. Lancaster FX. So now that we've identified the major risk factors, which results from high volatility, high leverage, unexpected interest rate changes, low liquidity, and an untrustworthy counterparty, a broker. So then let's look for the strategy to manage the risks. So there are many risks and money management strategies, but I will only discuss the basic 3. So one of the 3 strategies is focusing on the 3 pillars of risks and money management. So the 3 pillars consist of 1, the account size, 2, the leverage or the margin used, 3, the position size or lot size. Most brokers offer 2 to 3% leverage. So your account size determines the cash value of 2 to 3% maximum loss you can afford, which means it determines how far you can set your stop loss orders from your entry point. So the larger the account size, the wider the stop loss you can afford, and the more choices of trades you can have available to take according to your chart analysis. So how do you manage risks from your account size? So to manage risks from your account size, it is advisable to use a daily drawdown. A daily drawdown is the maximum amount of money you can afford to lose per day, which is in percent. For instance, let's say your daily drawdown, the DDD, is 10%, and the amount you are willing to lose per trade is 2%. So you will have to discipline yourself to open only 5 trades per day. Now, when your trades unfortunately end up in red with 2% losses, using stops and lot size that can take only 2% per trade, you may end up losing only 10% of your capital. So let's say in a $10,000 account size, your DDD is only 1,000. So you can only lose $1,000 per day and still have remaining $9,000 in your equity, which means you only lose a little portion of your capital per day. You still have multiple chances of making it right the following days, other than losing 50 or the whole of your capital in one day, and you just remain on bench watching the game going on. And 2% loss per trade will be $200. But in a $1,000 account size, your DDD is $100, and your 2% loss per trade will be only $20. So you can even make your daily drawdown lesser than 10%. And you can also increase the account size, meaning you can use 5% daily drawdown for a 3,000 account size instead of 1,000 account size that I illustrate here in this example. So for a given account size, the maximum loss you can safely afford is the function of the leverage or margin use and the position size or the lot size, which are the remaining 2 of the 3 pillars of risk and money management. And the second pillars of risk and money management is leverage or margin use. And this fixes the percent loss you incur for each 2 to 3% price move against you per lot traded. So the greater the leverage or the lower the margin, the greater the percent loss for each 2 to 3% price move against you. And the lower the leverage or the higher the margin, and the smaller the percent price moves against you without exceeding that 2 to 3%. That means the higher the leverage, the higher the risks and the profit potential per trade. Some brokers allows you to adjust the leverage to your taste, but some don't. So it is advisable that you reduce the leverage in order to minimize the risks and trade safe in the forex market. Now the third pillar of risk and money management is the position size or the lot size. It determines cash value of each pip or 2 to 3%. For a given leverage setting, the larger the lot size used, the more every pip moves against you. That means the larger the lot size, the higher the risks and the potential profits. So it is advisable that you categorize the risks. For example, using an account size of $1,000, now the lot size under the level 1 is going to be 0.2, while under level 2 is going to be 0.6. Level 3 will be 1 lot, and level 4 will be 2 lots. While under account size of $10,000, the lot size under level 1 will be 2 lot size, and level 2 will be 6 lot size, and level 3 will be 10 lot size, while level 4 will be 20 lot size. So under the account size of 1,000, 2 trades is expected, while under account size of 10,000, 3 trades is expected to open, with the exception of gold instrument. And this illustration is for scalping techniques. While for the intraday techniques, under level 1, for account size of $1,000, the lot size will be 0.1, and under level 2, the lot size will be 0.2. Under level 3, the lot size will be 0.6. Then under level 4, it will be 1 lot. While same under intraday, and the account size of $10,000, the level 1 lot size will be 0.1. The level 2 lot size will be 0.3. The level 2 lot size will be 3 lots. The level 3 lot size will be 6 lot size. And the level 4 lot size will be 10 lot size. So on gold market, you have to reduce the lot size by half because gold is very, very volatile in the forex market. Another way to reduce risks under position size is through layering, where you'll be adding lot size gradually as price goes against you with 10 to 15 pips and keep it consistent, and still maintain 2% per trade and 10% daily day drawn. So this different risk level idea is just for you to choose which one that suits you. To me, I recommend the level 1 because looking at the stops I give in the scalping techniques, which is 30 pips, and the intraday techniques, which is 60 pips. Now considering their lot size respectively, you understand that the 2% per trade and the 10% daily day drawn still maintain. But if you still think you are very much aggressive in trading, you can increase it to level 2, and gradually as you're making more profits in the market, you can still increase it to maybe level 3 or even level 4, but not to start with level 2 or 3. And it is advisable that you open different accounts for a different risk level in case if you want to trade across the different levels and diversify your risks in the market, because they have high chances of substantial risks as well as high potential profits. The second strategy is risks and money management psychology. Trading psychology is paramount in minimizing risks in the forex industry. This is simply because trading is a mind game. You will have to solve many puzzles every time to enable you come up with profitable and less risk pairs or instruments to trade. Forex is very tricky. It plays with your mind and targets your emotion to hurt you. Now, if you don't react carefully and smartly, you will probably end up on the bench watching the game going on, because the system is designed to swallow you, retail traders, to enable government control price fluctuations. So you will have to be prepared, well equipped, well informed, well emotionally balanced to use all your arsenals to overturn the system. Some of the tools in trading psychology you could use to reduce risks are as follows. 1. Capital preservation is more important than capital appreciation. 2. Remember not your losses. They can be very poisonous to your mind and very destructive to your equity. 3. When you feel like to add more, it's time for you to exit the market. 4. Trade on the money you don't need. 5. Winning and losing streak are both dangerous to your mind and destructive to your equity. 6. When you lose money too much that you can bear, take some time off and walk around and catch some fresh air. 7. Your mental status is the most influential factor in the profit making. 8. Bad risk management can destroy a good system. 9. Good risk management is more important than having a good system. 10. Bad risk management can turn a profitable system into an unprofitable system, but not vice versa. The last strategy that we'll be discussing here under risks and money management is discovering yourself. Now, to discover yourself means to work on yourself. You will need to cultivate good attitudes and the right mindset towards the Forex trading. The greatest enemy in the Forex industry is you, because it takes only pressing a button to raise you up and to succeed, as well as to bring you down in the Forex industry. So you will need to have a good trading system with a trading plan that will enable you to have a sound decision making in Forex trading. If you have a trading system already, then attach risk and money management to it. But if you don't have one, you will have to build it first and adopt risk and money management to it. So I recommend you build the trading system yourself rather than fitting into someone else's trading system or someone else's trading style. We have individual differences. What will work for one person may not work for the other. And you building the system yourself gives you an edge and enables you to have a total control of your trading and the ability to minimize the risks in Forex trading. Your trading system should be able to conform to scalping or intraday or swing trading, or even all of the categories, considering their stops and time frame respectively. This will also help you understand the risks you're taking and enables you to manage it. Other things you must consider when building a profitable trading system are as follows. Number 1, skill level. Traders with only basic analytical skills need simple methods, not sophisticated and complex analysis. Beginners should avoid short-time day trading, scalping, because it requires more technical analysis skill, but they can use it to learn price behavior on demo trading. This helps to reduce the level of risks in the Forex trading. Traders with good experience and strong technical analytical skill may want to go for short-time trading, scalping, to quickly analyze and refine their strategy under low risk condition or environment. Number 2 things to consider is the lifestyle. This includes the time and the energy available for you to monitor trades constantly. Now, if you don't have time and energy, then go for trading methods that doesn't require much of your time to constantly monitor trades, like intraday and swing trading, to reduce risk level in your trading. The third thing to consider is the temperament. This involves your personal life and is very important in risk and money management in Forex trading. A good trader will have to go through a mental discipline and emotional control. Different traders feel different degrees of stress when risking their money. Some traders easily get angry and frustrated when losing their trades and quickly go for revenge with a recovery setup. And some traders lack discipline to overcome their greeds and take small profits quickly. Some don't have the guts to admit they are wrong and cut losses before the market closes their positions, or they close too early because of fear of losing their trade, even though the analysis tells them that there is still room for price to go further. So considering this, admitting the fact that you are wrong, avoid anger problem, and close early will have a long way in helping you to manage the risks. Another thing to consider is risk tolerance. If you don't handle your risks very well, you will need more conservative lower risk environment to trade. Lower or zero leverage, smaller positions, and longer time frames are few ways to trade under minimum level of risk. And also, based on your experience, skills, and the size of trades and the account size, you will have to evaluate and examine the level of risks you are willing to accept. Using a good risk-reward ratio will help you manage risks and your money properly in the Forex market.